Good morning, everyone. Can you guys hear me? Cameras on, please. You all here happen right now. And then you just took over the microphone. If you want to be the host, Nady, no problem. All right, guys, make sure. Yeah, your microphone went on. I don't know why. Make sure your cameras are on, please, before we start. You guys have no questions to drop in the chat before we start? Can anybody know? Let me know if YouTube's working since we're at this. We're waiting for a few cameras to come on. Marta already approved you yesterday. You should be able to get in, but for some reason you went to the Dearborn one. Can you check and confirm that you're there? Can anybody let me know if YouTube is working, please? I don't know, I cannot see. It's giving me an error here. Help me out, please. Anyone? Don't everybody go to YouTube at the same time. It's okay. And Sam is driving. Alright. Alright, guys. So, Juan, you're asking how many questions are in the state exam. There's 110 questions for the New Jersey state exam. That every state has their own amount of questions. All right, Sam, I appreciate it. All right, cool. So, start the second half of this. Anna. So Anna just said on YouTube, now it's 120 questions. So yes and no. If you look at your, I don't know if you took the test already. If you did, and you look, and for some reason you did not pass, look at your score report. It says you had, let's say 60, 70, whatever it is, correct answers, and then it says right next to it says 110 questions. During the exam, they give you an extra. This is in the PSI bulletin that explains how the exam goes. They have an additional 10 questions, which are just fluff. They're not there to. They're easy questions just to help you going, so you de-stress type of thing. It's a total of 120 questions again, but only 110 actually count. Okay, so if you look at your score report, it says 110. Right, that's for the salesperson. If you're doing the brokers, might be a little bit different, and if you're doing the instructor, is definitely. All right, so Nady's asking, what happened when I went to the meeting? Did anything change? Yeah. So it's not going to be implemented to this class yet, the changes. But yeah, some things changed. They will roll out a few features, new features within the next 6 months. One of the things that was positive is that, and I'm going to announce that, I'm going to create a video and announce that over the weekend. We're going back to being able to do class in class, limited amount of people, but we're going to have the physical in class, and we still allowed to do the online. So we could go hybrid. So I can do half and half, which is what I've been preparing for anyway for a couple of years. So it kind of works out for me. They're also making other changes, but I don't want to disclose now because I don't want some of you to go like, so I can relax and wait. No. There's a couple of changes for people with language barrier. That's all I can say. All right? But I don't know when it's going to be implemented 100%, and that's why I don't want to talk about it yet. And I'm waiting still on their, because we had a meeting, now we're waiting on having the summary of that meeting and all the changes detailed. So yeah, there's a few good things happening to the point where I canceled the rest of December's classes, so we can start only in January, and I can adjust what we're gonna do. So good changes. There's bad stuff as well, like unfortunately, but there's a lot of good stuff. All right. So let's go to mortgage market. Let's address this chapter. I'm having a little issue here with lights, as you guys can see. Just see if I can correct this real quick. It's bothering me. Give me just 1 second. All right, we are back. Does this look better? Image good? Right? All right, good. You guys don't know how much this thing bothers me, the lights. Anyway, all right, cool. So we're going to start talking about the mortgage market, right? Yesterday we talked about what a mortgage was. We talked about what a promissory note was. So with that, I have a question before we go into the mortgage market, because we need to understand what a mortgage is, right? So guys, what is a mortgage? Who can tell me? What is a mortgage? Let me know in the chat. Don't yell at the camera, just write it down in the chat. And Tiana says death. Well, good morning to you too. There's more to mortgage, it's not just death. Yanita says, and Juan say house and home. Perfect. Because it represents the house or a home. But what is a mortgage? Oh, Tiana, no. Death grip on a home. Yes. So the mortgage is a death grip or pledge on a home. It's not just death, Tiana. Okay. So it's a death pledge or death grip on a home. Correct. Now, so therefore, because it's a grip or a pledge, it's a lien against the house. So the mortgage represents the house, right? You got to remember that. Mortgage represents the house. So it's a lien against the house. What is a promissory note then? What is a promissory note? Let me know in the chat. YouTubers, if you're watching, let me know in the chat as well. Promise, Danny. Okay, perfect. Yeah, don't worry about it. I got you. Promise to pay like a check. Yes, promise to pay. Correct. So the promissory note or note by itself is the promise to pay. So that's the one that has the personal liability. That's the one that attaches to you. So the mortgage attaches to the house, where the promissory note attaches to you, the individual. So if they get the house from the sheriff's sale and there's not enough money to pay off the debt, they can come after you personally for the difference, right? So you have a security, right? And if that security is taken away, then it becomes like a credit card. They can still collect on you. All right. Now, in the first part of it, we also talked about mortgagor and mortgagee. Guys, who's the mortgagor? It's important. Who's the mortgagor? Right, owner and then back. Bank? No. You were right the first time. It's the owner, the borrower. The mortgagor is the one that creates it. The mortgagor, the OR, is short for owner. Okay? And the borrower, when they borrow monies because they intend to buy, they sign it at the time of closing. Remember I explained this? They sign at the time of closing saying, hey, you're going to lend me money for the house I'm about to buy, and I'm giving up the same house as collateral for the loan you're about to give me. Everything happens at the same time because there's two closings, the closing of the loan and the closing of the house. All right? So when you sign those documents, the borrower becomes the owner. The borrower is the one that gives up the house to the bank. So the borrower is the one that gives the house to the bank. And what do you receive in return? The money. From who? From the mortgagee. All right? So mortgagor is the owner, OR for owner. Mortgagee is lender. So two E's, just like lender has two E's. Okay? Lender. If you guys remember the table that I showed you yesterday, the ORs are the ones that give up the property but receive money. The E's are the ones that receive the property but give up money. So grantor, lessor, mortgagor, these are always the owner of the property. Grantor is the seller that gives up the property to the grantee, the buyer. Okay? Lessor is the landlord that gives up the property temporarily to the lessee, the tenant. Mortgagor is the borrower that gives up the property or the grip to the property as long as they're paying the mortgage. To who? To the mortgagee, the lender. And the E's give money, whether it's the purchase price, the rent, or the loan amount. They give it to the owner. Okay, you got to remember that, those two. All right. So another thing that we talked about, we're going to talk about here briefly, right? Another thing that we talked about was the fact that, just like Danny wrote earlier, we talked about the fact that the promissory note functions like a check. One of the things that means is that it's assignable, right? It means that it's tradable. That means that you can give to somebody else. Just like when you receive a check, if you remember, I talked about this in the regarding your salary. When you receive a paycheck, right? You run to the bank to deposit. What you're doing is assigning it or gifting it to the bank where you bank with. So if you bank with Chase, you gave up the piece of paper to Chase. You go to Chase and say, hey, I want to deposit this here because my boss told me that there was money in this paper. So deposit it here, please. And Chase, what they do is they stamp it and say, yeah, by your signature, you endorsed the check to us. So you transferred the check to us, says Chase. You guys understand? Good so far? Great. So Chase, in the scenario that we're talking about here, Chase is in the secondary market, where your boss, your employer that gave you the check, is in the primary market. So I'm going to explain that better in a second. There's primary, where things originate, and there's secondary, where things are traded, bought, sold, assigned. Okay, that's a lot of things that some of the things we talked about yesterday. Let's talk about supply and demand for money. Supply and demand. Now, we already did chapter 16, and we already did chapter 15, where we talked about the real estate market, and we talked about appraisals, right? And in these two, hey Rose, good morning. In these two chapters, we talked about supply and demand quite a bit, right? Supply is how much we have of something. Demand is how much is wanted or desired of something. So there is supply and demand for money. And don't get me wrong, everybody wants money, right? But we're talking about mortgages. And supply and demand for money, before I read, supply and demand for money is, we have the whole country, but I'm going to narrow down to, let's say here, Newark, where I'm at, okay? And in Newark, because it's a high volume, right? There, every time a house goes for sale, there's a lot of people that want to buy, and it's quick, right? It's a hot market. So in hot markets, that's what I'm going to call it right now. In a hot market, there's higher demand. Okay, so if you're in a hot market, there's higher demand for what? For money. Why? Because there's more loans. There's more loans, right? The question is, do you think Chase, Bank of America, TD Bank, Wells Fargo, all these institutional lenders, do you think they have all this money laying around that they can just lend to all the people here? No. So what they do is, in areas that are hot, they will lend money. That's step number one. And step number two, they will sell the money. I'll explain better in a second. All right? And that will lead us to step number three, where we can lend more money. Okay? Lend more. And then step number four, we sell more. And five, and so on. So because it's an area with high demand, where people are buying, and any house that goes on the market sells, banks need to have the money to lend to you. How do they do that? Again, it's like wholesaling, right? I consider this wholesaling. Wholesaling is I find the property, but I cannot keep on buying properties. I wish I had like a $300 billion and just buy all the houses out there, but I can't, right? I don't even have $300 million to buy all the houses out there, right? So there's limitations. If you have only $10,000, there's a limitation. It doesn't stop you because you can wholesale. You put it under contract and you flip it to somebody else. Well, guess what? In the mortgage world, that's what it is. They lend. It's like putting on the contract. They lend, and then they wholesale it to another lender. Okay, so they're going to sell. So let's say Bank of America lends the money, right? And then they're going to sell to Chase or Wells Fargo or a private institution. We're going to talk about Fannie Mae, Freddie Mac, and so on. So in effect, this transfer right here is like wholesaling. It's an assignment. Okay, I'm just explaining. I know you cannot read. I'm just explaining. Speaking of which, Tiana, you got your contacts? All right, you're good? All right, cool. So now you can read. I don't have to zoom in like crazy. All right, so let me zoom out. You guys can read. Perfect. Things I do for students. All right, so here's the thing that happened. Bank of America lends to people in Newark. Bank of America needs more money to lend to more people in Newark because it's a hot market. Bank of America will then sell the loan that they just made to Chase or anybody in the secondary market, and then Chase is the one that collects from you. So, Clenard, if Bank of America lent to you, right, at the end of the day, or a month later, or a year later, or even 10 years later, whenever they're ready, they're going to assign to another lender. And then Chase sends you a letter that says, hey, Clenard, we're the new guys, right? Instead of paying Bank of America, pay us now, right? So that's what happens. They assign, just like that check that you went to deposit, they assign or transfer to the secondary market, to somebody that's willing to buy the note, right? So, or the obligation. So right here it says, money is a limited commodity subject to the effect of supply and demand. And the federal government's monetary policy controls the supply of money in order to achieve the country's economic goals. An excessive supply of money usually causes interest rates to fall and consumers' prices to rise. Conversely, an excessive demand for money, such as mortgage loans, causes interest rates to rise and prices to fall. The regulation of money supply addresses these fluctuations with the aim to control and limit the wide swings in the supply and demand cycle. These efforts in turn help to buffer the economy from severe inflationary and recessionary trends. Let's talk about regulation of money supply. Who regulates money supply? Remember that all money comes from the Federal Reserve. Okay? In fact, if you pull a dollar bill right now, $10 bill, $100 bill, whatever you pull right now, it says Federal Reserve note. Yes, I said it. Note. Note because it's an IOU. It's a promise that the United States is making to the Federal Reserve, right, that they have money to back up what they're borrowing. All right? So yes, the United States borrows from the Federal Reserve, from a third-party private entity. Isn't that crazy? But I'm not going to get into that right now. All right, so the Federal Reserve regulates the money flow in three ways. One is by selling or repurchasing government securities, primarily the treasury bills. Two, by changing the reserve requirements for member banks. The reserve is how much money or what percentage they have to keep in the bank and cannot be lent out. All right. So right now the percentage is roughly 5%, but all they required was 10% before. Now it's even lower, 5%. At one point they're like, yeah, we're not regulating that. Lend everything out if you have to, right? But this means depositors' funds. This means that the money you guys deposit into the bank account, it's not there. If your bank account has a lot of zeros, I'm going to say this way. If your bank account has a lot of zeros, right, whatever amount of zeros doesn't matter, but if you have a lot of zeros and you go to Bank of America and say, hey, I want to cash out everything, they'll tell you you have to make an appointment and show up 5 days later, for instance. Why? Because they need to source the money. It's not there. It doesn't exist. They already lent out the money. They don't have it. You guys understand? So they keep a percentage. They lend out the rest. So for every dollar you deposit, they are lending out the majority of it. Okay? Or the other way, the third way, which is one of the most common ways as well, is charging the interest rate or discount rate that they charge to the banks that borrow from them. So Bank of America, he goes to Federal Reserve and says, hey, I need more money, right? Federal Reserve lends money to Bank of America at a tiny percentage, 0.54 something percent. So a little bit over 0.5%. Just a little bit over 0.5% is what they charge. And then to you guys, of course, they charge you 2, 3, 4, 5, and so on. Not bad, right? So that's the way banking system works. Federal Reserve, a private entity, controls the banks and the United States. But anyway, when the Federal Reserve Treasury sells Treasury bills, the money paid for the securities is removed from the economy's money supply. Conversely, when it repurchases Treasury bills, the cash paid out to investors puts money back into the economy. The second control, like we said, is reserve requirements, and the third control is how much can the banks borrow and at what rate can they borrow. Now we're going to address the primary mortgage market and then the secondary mortgage market. And with that being said, I always have a question in every single class, which is, what are the primary colors? Let me know in the chat, what are the primary colors? What are the primary colors? Red, white, and blue. That's the United States colors. But you're close. You're close. You're just missing one. You just have one wrong there. Anybody else? I said there's one wrong. Sanady goes like, hey, let me put 3 more. Yellow, blue, and red. Kiana just says green. Red, yellow, and blue says Alexis. Okay. Anybody else? Okay, so let me ask you in a different way, because Sanady, you put like the Ecuadorian flag. There you go. I assume you're Ecuadorian then? Okay, that's why the pride. You went like, yeah, all right. We're the primary, he said. All right, so the first thing to understand, and Sanady, but I know you got this confused look on your face, but the first thing to understand is, what are primary colors? Can anybody tell me? Just one person. Tell me, what are the primary colors? What does it mean? Don't tell me what the colors are. What does it mean to be primary colors? Colors that you can mix, right? Great. To make other colors. Perfect. So do you think orange, because that's one of the answers you gave me, do you think orange is a primary color? No. That's why it was incorrect. Green, Tiana. I think green is a primary color? No. Green is a mix between the yellow and the blue. All right. Tiana, you got time because it's still a baby, right? You got time. But who has kids in kindergarten right now or just went through kindergarten? Anybody? You got 3 kids? And you don't know the primary colors? Your kids are going to grow up to be great. I'm just messing with you guys. All right, here's the cool thing. It's not about the colors. It's not about the colors. But the primary colors are red, yellow, and blue. These colors combined originate every other color. The point of primary and secondary, it was for you to remember that the primary colors originate everything. They are the first, because without the primary colors, there can't be secondary colors. So I really don't care, and I just like to mess with you guys because, listen, I was trying to remember something yesterday, trying to remember something from when I was in school, and I couldn't, for the life of me, could not remember what it was. All right, so to prove the point and to show you guys that I'm not messing with you regarding this, is simply we don't use the stuff from school unless you went into a profession that requires what you learn in school, right? So there's a lot of stuff like primary colors, unless you're painting or unless you have a passion for design and all that stuff, it really won't be a thing you need to know. But when you have kids, there's no excuse, Tiana. All right, so primary colors. In the primary mortgage market, loans are originated. So loans originate in the primary market. They start in the primary market. So Bank of America, when they lend to you for the purchase of your house, they were originating a loan. Therefore, they were initially in the primary market. Okay? Okay? And then later on, they sell to whom? To people in the secondary market. We're going to talk about secondary market later on, but could be me, could be you. It's investors, and those investors could be a bank, could be a private institution. All right. So primary mortgage market. It's where they originate the mortgage loans. That's what you need to remember. Because they will ask you which one of these are usually in the primary market, or which one of these are usually in the secondary market, something like that, right? Or which one of these will never be in the primary market. So you'll see. But in the primary market, we have lenders that lend directly to the borrowers. Savings and loans associations, commercial banks, mutual savings banks, life insurance companies, believe it or not, mortgage bankers, credit unions. All these operate in the primary market. They could also be in the secondary if they're the purchaser, but these are usually the ones strictly in the primary. Okay. Next, we have mortgage brokers. Now, what is a broker? Because we already talked about what real estate brokers are, right? So a broker, bless you, a broker is somebody that's in between, right? Somebody that's facilitating a transaction, whether for the seller or for the buyer, right? In the mortgage world, the seller is the lender and the buyer is the borrower. So in the mortgage world, a broker helps match a lender to the borrower, helps match them, bless you, helps match them in order to move forward with a transaction. So that's a mortgage broker. They are us, but in the mortgage world. Okay? They don't have money. I mean, they might have money, but they don't have money like we don't have houses, right? And they're not the ones borrowing, just like we're not the ones buying. They're the in-between. So mortgage brokers do not lend directly. Do not lend directly, which is different from mortgage bankers. A mortgage banker is a company that lends their money directly. Okay? So mortgage broker lends or helps you lend somebody else's money or connect, right? So it's like mortgagematch.com. And the mortgage banker lends directly. Okay? We also have portfolio lenders. When you see portfolio lenders, these are people that will stay in the primary market. For instance, if I lend money to you and I don't intend to sell to the secondary market, I'm considered a portfolio lender. Because what does portfolio mean? It means you keep it. It's yours. It's part of your portfolio. It's been yours and will stay yours until you sell it, right? So portfolio lenders, they keep the investments they made in you. They keep it in-house for the next 10, 20, 30 years. So if it was a 10-year loan, don't worry. It's going to start and it's going to die with us. We don't sell. If it's a 20-year loan, it's going to start and it's going to die with us. We don't sell. If it's a 30-year loan, the same scenario. So all I'm trying to say, Nadia, for instance, all I'm trying to say is you're going to see me for the next 30 years as your lender. That's a portfolio lender. You guys got it? The ones that are not portfolio lenders are those that sell to the secondary market. So portfolio lenders, they originate the loan for the purpose of keeping or retaining in their own portfolio without selling. Portfolio lenders, they keep it in-house, right? Usually, or mainly, the small banks. Small banks, they want to have that revenue. They don't lend too much. They have stricter criteria sometimes. I mean, way better than governments sometimes, but stricter criteria of the people they will, loans they will approve to keep in-house, to not have to sell later on. All right? They have flexibility in other things, but they don't have to follow all the standards like a bigger bank does. Okay? Secondary market. So primary market is where loans are originated. Secondary market is where loans are bought and sold. Okay? So it's where loans are bought and sold. It's in the secondary market. Okay? Keyword, after origination. Okay? So secondary market is the people that buy loans and sell loans. So your loan keeps on being traded or sold in the secondary market, much like the stock market, right? There's the original IPO, which is an initial public offering. At that point, nothing is traded. At that point, they're just somebody saying, hey, I'm stepping into the market. Anybody wants to buy us, right? And then after that, they're sold to the secondary market. And that's where they get traded and traded and traded, and you see the stock going up or down. So the initial public offering is like the primary market. And then after that, everything is game. Bought and sold several times. As long as the investors are willing to buy and whoever holding it is willing to sell, just like the stock market, your loans are bought and sold. Any questions so far? Not bad, right? So, lenders, investors, and government agencies, they buy loans already originated to someone else or originates loans indirectly through someone else. These constitute the secondary mortgage market. Some of the people that you're going to see in the mortgage market, the most common is Fannie Mae. Then it's Freddie Mac and Ginnie Mae. These are the big players in the secondary market. The largest one is Fannie Mae. Fannie Mae, we're going to go over that. She's like grandma. When grandma talks, everybody listens, right? I don't know how it is in your household, but mine is always like that. It's always been. Right? Nobody respects the parents, but if grandparents are around, that's it. They're also the coolest. But anyway, grandma, she buys all the loans. She tells the banks what to do or what not to do, and the banks listen. This is a private entity that's now under government oversight, but it's a private entity, another private entity. So we have Federal Reserve and now Fannie Mae that controls pretty much the banks, right? Then you have Freddie Mac, Ginnie Mae, right? But also investment firms. We could create an investment group and buy loans. Life insurance companies, they buy loans in the secondary market because they want to make sure with the money that you're giving them, life insurance company, you're giving them money, they want to make sure that if you die too soon, meaning they did not collect enough money from you to be able to pay out, right? If you die too soon, they want to make sure that they have enough money. So they invest as well in the secondary market. And they collect money from all these mortgages over time, right? So they're protecting the investment. Pension funds, they're always buying stuff, and that's how your buying stuff in the secondary market. Could be bonds, could be stock, whatever. But they're buying in the secondary market to secure your pension, because what you contribute is not enough to pay everybody out once you retire. Does that make sense? They have to invest the money, grow the portfolio, so then they can pay you out when you retire. And you have primary market institutions who also invest in, as secondary lenders. So like I said, Bank of America sold to Chase in my previous example. Chase is in the primary market as well because they also lend. But depending on the loan, they might want to be in the secondary market as well. So they can be in one or the other. All right? So these ones, the first ones that I talked about, usually there are no, they have no position in the primary market. Usually they're only in the secondary market. So if the exam says, which one of these will never be in the primary market? They're going to give you 4 options. One of them I can almost guarantee is going to be Fannie Mae or Freddie Mac. Never in the primary market. They don't lend directly. Okay? They buy loans. So one of the questions that might be in the state exam is exactly that. So Nady, I just read your message. As long as we're not talking about Sally Mae, then we're good. Okay. So Sally Mae is no longer around. It's a different name. It's a different name. But she's not the thief of the pack. Anyway, let me not get into that because I'm going to waste a lot of time talking about student loans and stuff. So no, let me skip that. I have to say it. I'm sorry. It's biting right here. The real thief of the pack is your government. It's not Sally Mae. Any government. Not just ours. Any government. The real thief is them because they allow these things to happen. Okay? Like the student debt that's happening now, that's about reset a bunch of stuff. The student debt that's happening originally was not intended to have interest rate or anything like that. It was supposed to be to help people go through school, but then it turned into a business for both the government and the universities. So at the end of the day, and you can tell that by our education system, they really don't care about you. It's all about monies. Sucks. Anyway, I'm not against the government, by the way. Don't start a movement. Not against the government. I think government should exist, some type of order, right? I might just be against this government, or even my government in Portugal. Like the way things have been running for the past 20, 30, 40, 50 years, maybe even more. Anyway, so the secondary market, organizations, they buy pools of mortgages from primary lenders, and then they sell securities backed by these pooled mortgages to investors. By selling securities, the secondary market brings investor money into the mortgage market. So by purchasing loans from primary lenders, secondary market returns funds to the primary lenders, like I was saying before, enabling the primary lender to originate more mortgage loans. So primary lender lends, sells into the secondary market, receives money, lends more. Obviously, I told you it was like wholesaling, right? So obviously, when you wholesale, right, as I was explaining to Marta the other day, right, and to your son, wholesaling, we transfer the contract and we keep some money. For me to release, I'm going to keep some money. So the same thing happens here. When I sell the loan to the secondary market, right, just like debt collectors. Debt collectors, they buy for cents on the dollar. What are they buying? The future collection, right? So it's worth 500, but over 30 years, it's worth 700 over 30 years. So if I sell to you for 510, right, you're still going to make $190,000 over the next few years. So you paid me 10 in order to have that benefit. You guys understand? So banks make money immediately, overnight, by selling a bunch of loans. Okay? So the way things work, I'm going to start with the borrowers and move back. The borrowers want money. They go to the bank, primary lenders. Primary lenders, to lend to you, They go to the secondary market because they need more money. Who's in the secondary markets? Investors. Okay, so investors buy in the secondary markets for the banks in the primary market to lend to you. It's as simple as that. Guys good? Okay, great. And if you guys want to learn more about what I said regarding Sallie Mae and everything else that I'm talking about here, sorry, I'm gonna make it nice and neat for some of you. Watch this movie, The Big Short. Okay, and there's more. There's more movies, but watch this movie. You have The Big Short. You have The Wolf of Wall Street. Okay, you have Too Big to Fail. Right. You have, believe it or not, you have Despicable Me. Yes, right now, Alexis. Yeah, stop this class. Go watch the movie. And another one, it's called The Good Guys. Go watch it as well. Marta, I charge more if you want to have more people on the screen. I charge double or triple. I'm not sure. I'll figure it out later. What's going on? You can stay. I was just kidding. I didn't hear it, so I don't know. All right, that's 10 times more. Martha, what happened right now is 10 times more. That we're PG-13. All right, kissing people as they walk away is very expensive. All right, terrible, terrible. Interrupting Ann. All right, let's talk about Fannie Mae, Ginnie Mae, and Freddie Mac, guys. Fannie Mae, Ginnie Mae, and Freddie Mac. YouTubers, if you have any question, drop them in the chat. You guys can do whatever you want because you're not on camera, so I'm okay with. If you want to talk to people or see people or whatever, it's fine. So we're going to talk about Fannie Mae, Ginnie Mae, Freddie Mac. So Fannie Mae, we're going to start with Grandma. Fannie Mae is the Federal National Mortgage Association. Federal National Mortgage Association. FNMA. Therefore, Fannie Mae. The next one, I don't know why you got to Freddie Mac, okay? Because the acronym is totally off. But Fannie Mae. What Fannie Mae does, they're a privately owned company, as you see right here. They're a privately owned company. What they do is they buy conventional FHA and VA-backed loans. So pretty much they buy anything, okay? They give the banks mortgage-backed securities in exchange for blocks of mortgages. They offer lenders firm loan purchase commitments, provided that they conform to Fannie Mae's guidelines. I'm going to explain that in a second. And they sell bonds and mortgage-backed securities as well. And then they guarantee payment of interest and principal on mortgage-backed securities. So what Fannie Mae does, if you guys saw this here, is if the banks agree to what Fannie Mae wants, they'll buy the loans from the banks. So the banks can now offer to the borrower, they can offer a solid commitment to lend. All right? And I want you to think about it this way. If I'm your investor, like I'm the dedicated investor to you guys, right? And I tell you guys, look, I only have one requirement. Bring me any house. I don't care what house it is. If it's a single family, 2, 3, 4, I don't care. What I care is that the house is the color green, for instance, right? How many houses would you bring me? If I told you I'll buy anything as long as it's green, how many houses would you bring me? Let me know in the chat. YouTubers, let me know in the chat as well. If I told you that I would buy any house as long as it's green, how many would you bring me? I'm your investor. You're my realtor. I'm your investor. How many houses would you bring me? Don't everybody answer at the same time, okay? Like, don't worry about it. Just one is fine. So Nate says, all the greens I can find. Okay. Anybody else? All right. Nalini, what's up? Good morning. As many greenhouses as I can find. Okay, cool. Yana says, I agree with like whatever she said. I like that. Okay. Juan just gave me a great answer. Look at this, everybody. Look at this. All the ones I can find and paint green. So if you guys watch The Big Short, you'll understand that the lenders said, oh, Fannie Mae, you're buying everything as long as it's within these guidelines, this flexible guidelines for us. Oh yeah? Then we're going to package a bunch of loans that meet your guidelines, and we might just paint a few of them green. Like we're going to paint a picture to you, Fannie Mae, that these loans meet your criteria. The problem is the loans that supposedly met the criteria, some of them defaulted. But everybody got so comfortable in painting the loans green, making them to Fannie Mae standards, right? I don't know if you guys remember, some of you definitely not, but I don't know if you guys remembered, but back in 2006, as long as you had a pulse and you could breathe, like you had a pulse, you could breathe, that's it. You got a loan. You were approved. Back then, that was it. You make $10,000 a month? No. You make $100,000 a month. You make $500 a month? No. You make $5,000 a month. They will write down whatever. They were painting them green. So if you guys did not get on the wave of buying houses back then, you lost a lot. Because back then, it was 100% loans, no questions asked. We call them the ninja loans. No income, no job, no assets. Meaning you did not have to prove anything. You just have to state that you made this, and they would put it on the paper and approve you. That's what was happening back then, right? So they were painting it green to make sure they meet Fannie Mae's. And it's like you guys are saying, you'll bring. And the banks are doing whatever Fannie Mae wants, because Fannie Mae buys 1 out of every 10 mortgages that's issued. I know it doesn't sound like a lot, right? But 1 out of every 10, when you have probably hundreds of thousands of other players on the market, right? Now it sounds like a lot. They buy 10% of every loan originated. Think about that. There's 90% for the other hundreds of thousands of other investors out there. So they buy a lot. So whatever Fannie Mae says, they'll go for. This is just to say that if you go to Bank of America, if you go to Wells Fargo, if you go to Chase, and they say, hey, congratulations, you're approved, there's one reason and one sole reason why you're approved. Because your loan meets the sellability to Fannie Mae. Did you guys understand? Your loan meets Fannie Mae guidelines. Fannie Mae says, we will lend up to $500,000 on a single family, as an example. It's more than that, but I'm just keeping the number simple. $500,000 on a single family. The credit score has to be around 640, for instance, right? The square footage of this type of house cannot be more than this. The amount of rooms cannot be more than that. So they qualify the house and they qualify the borrower, right? As we spoke about yesterday. And if that loan meets what Fannie Mae says, then guess what? Bank of America already knows that as soon as you sign that paper, they can sell the same day. The same day your loan could be sold to Fannie Mae. Did you guys understand this? That's the power that Fannie Mae has over the banks. So if the bank says no to you, they only said no because you don't meet, it's not the bank's guidelines, it's Fannie Mae's guidelines. You are not a sellable loan. Let's think about that. All right? But you have to remember that there's other players. We have, if Bank of America says no, you guys can always go to a credit union. You can deal with mortgage bankers that lend their money directly according to their guidelines, right? You can go to mutual savings banks or savings and loans associations. Commercial banks, which is like Bank of America, They might say no because of the sellability to the secondary market. You guys got it? So pretty much whatever Fannie Mae says is what goes. Your loan will be denied because of that. Got it? Or will be approved because of that. If you have a buyer, and again, this is, you probably won't remember once after you get your license. I mean, after you pass the exam, you probably won't remember, but when you're in it, you will. This is just to say, if the lender says no, that's why I like to work with mortgage bankers or even mortgage brokers and not directly with commercial banks. If that bank says no, tell your borrowers, hey, listen, they said no, let's shop around. There's other alternatives, there's other programs. You guys understand? Right? And if they said no, let's figure out why they said no. What is the reason they said no? Oh, your credit score is too low. Well, that's an easy fix. That's an easy fix, Mr. Buyer or Mrs. Buyer. Don't worry about it. So you're not buying today. We could buy in 2-3 months. All we need to do is fix some things. You guys understand? A lot of realtors waste a lot of their leads because the bank said no. Oh, he's not ready to buy. Not now. Later. Don't lose your clients. Help them. Associate yourself with 1 or 2 credit experts that will be able to explain to the borrowers the steps that they need to take or that they should take to get to the credit score they need to pass. You guys understand? So never let it go because the bank said no, because Fannie Mae says no, right? If your loan's not sellable, you'll get a stamp that says rejected. Let's make your loan sellable. Not now, later. All right, so not as much for state exam, but to help you in real life as soon as you get your license, make sure you don't lose clients ever. Okay. The next one is Ginnie Mae. Ginnie Mae is like the new kid on the block. It's the baby. So Fannie Mae was grandma. She's been around forever. Ginnie Mae is a new kid on the block because of 2008 to 2009 crash. Ginnie Mae was created to deal with special assistance programs and help Fannie Mae in the secondary market and guarantee payment on Fannie Mae's high-risk, low-yield mortgages. So those ones that were painted green, like Juan did, right? You'll be one of those guys that just packages the bad stuff with the good stuff so you don't notice, right? So that's what he did. They did it back then. And now Fannie Mae defaulted, and government came to the rescue. They bailed out Fannie Mae and Freddie Mac, the next one, right? And created Ginnie Mae to assist with high-risk mortgages, okay? But remember, if there's a question about Ginnie Mae, it's about high-risk and low-yield mortgages, all right? And the next one, Freddie Mac. This is the reason I don't know why they call it Freddie Mac. Because the acronym, it's FHLMC. That's the acronym. The only thing for Mac is the MC, right? You can do MC, Mac. Now, how do you go from FHL to Freddie? Crazy, right? Complete side note. Anyway, so Freddie Mac is Mac Daddy. He's like been around not as long as the Fannie Mae, but he's been around. And what Freddie Mac does is they buy mainly conventional loans from savings and loan associations, but they buy mortgages. They pool the mortgages together again. So the whole Big Short, the movie, is again key for you guys to understand this. Maybe not for the exam, but for later. But they pool the mortgages together, and then they sell bonds, which are guarantees. Bonds are guarantee, guys. Bonds are guarantees. They sell bonds in the secondary market, right? So your 401k is probably buying bonds, guarantees, right? The problem is that even bonds can default. That's where the Big Short comes in again. They got to the point they were selling bonds of bonds of bonds of bonds of bonds of bonds. So guarantees of the guarantees of the guarantees of the guarantees. Yeah. People started betting, that's what the short is, like people started betting that it was going to fail. And when they started betting that it was going to fail, those that bet against the real estate market, which is unprecedented, those that bet against the real estate market, they made a ridiculous ton of money. Those that knew what was going to happen made a ridiculous ton of money. All right? So that's what the secondary market does. Any questions? All right, we've got 5 people watching on YouTube. If you guys have questions, you can always drop it right there in the live YouTube chat. Zoomers, if you have questions, drop them. So again, primary market, this is what we started with. Primary market, where loans are originated. They lend to you directly. And then secondary market, whoever the lender was for you, sells to people on the secondary market. Who's on the secondary market? Mainly Fannie Mae, Freddie Mac, Ginnie Mae, but also life insurance companies, private investor groups, could even be Bank of America. In certain markets, they will buy those loans. Okay? Let me know if you have questions. No questions? Good? All right, so no questions, we're going to move on to types of real estate loans. Now these first 3 you have to know for your profession. These are the basic, Tiana Coffee. These are the basic ones for you to know. They will be always there, always present. Conventional loans, FHA loans, and VA loans. These 3, even though it says FHA and it says VA, they all come from local lenders. All right, the reason why I'm writing this is a lot of people think FHA and VA come from the government. No. All right? The term FHA, and we're going to read this in a little bit, means that it's insured by the Federal Housing Administration. The term VA means that it's guaranteed by VA, by the Veteran Affairs. So it's very important that you know these are the basic types of loans that will come out, and they're given by local lenders. So Bank of America gives you a conventional loan. It's between you and the bank directly. Bank of America gives you an FHA loan. It's between you, the bank, and the government. Bank of America gives you the VA loan. It's between you, the bank, and the government. So the only difference between the conventional and these government-sponsored programs is that Bank of America, still the local lender, right? They have to go by FHA or VA guidelines, okay? Conventional loans, it's the bank's own guidelines, right? Make sure you guys understand this clearly, because I know some of you make a mistake in the state exam or school exam regarding these. The loans do not come from the government. The loans are from local lenders that follow FHA or VA guidelines. And they have to be approved to be FHA lenders. They have to be approved to be VA lenders. Okay? Now, who's insured and who's guaranteed in these loans? The lender, not you. Okay? So when they say FHA insured, it means that FHA or the Federal Housing Administration insures the lender. You pay for it, right? We talked about it yesterday. We talked about PMI and MIP, right? You pay for that insurance by paying that premium every month. But the insurance is not for you, it's for the lender. Okay? The VA guarantees the lender that if the veteran defaults, the VA will cover. Okay, and this is why you get 100% loans with the VAs. Because if you default, VA says, don't worry about it, here's the money. What do you need? Right? So that's the difference. All loans, all these loan structures come from local lenders. Good? Great. Let's start with conventional. So a conventional mortgage is one that is not FHA insured or VA guaranteed. So if there's no government touch to it, it's a conventional or traditional mortgage. That means conventional means between lender and borrower only. Okay? Between lender and borrower only. No government influence. Okay? So not FHA insured or VA guaranteed. Something other two. All right, so you guys go with this, right? Conventional between you and the bank only. There's no FHA, there's no VA problem. Okay. Now, because of the lack of insurance or guarantee by a government, the risk to a lender is greater. This is why I don't lend money, right? To just for whatever reason, right? There has to be a really good security for me to lend money. But this is exactly the reason. I'm not FHA or VA insured. I'm not insured by the government. So I'm fully exposed that if you don't pay, what do I get? You guys understand? When you lend money directly, when you're a private lender, you have to have either a bigger cushion. That's why private lenders don't give more than 65% of the loan, for instance, unless they're well-established lenders and have tons of money or insurances, right? But they don't lend more than 65%. That's a conservative private lender. And they charge you upfront. They charge you points. We talked about points, right? They charge you still the down payment and higher interest rates, right? So private lenders have way higher interest rates than regular banks. Criteria for approval is usually the deal versus you, usually. Your part of it is going to be important as well. Like, do you have a good credit score? Do you have assets? I don't care much about it, right? I'm not asking for you to put up your house as collateral, but I need to know who you are before I can lend you on a project, right? And then let me look at the house as well. And if that project is a doable project, then I'll lend to you. But it's the same scenario. It's a greater exposure for a conventional loan. Conventional lenders, okay, they have greater exposure. So stricter requirements for down payment, higher interest rates, and borrower's income qualification. But at the same time, conventional loans allow greater flexibility in fees, rates, and terms than do insured and guaranteed loans. All right. So people sometimes ask me, well, Bruno, which one is the best? Should I get an FHA? Should I get a conventional loan? All depends. First of all, can you qualify for a conventional? That's the first thing. Second, why not do both? Start with FHA now and then do a conventional later. And I'll tell you why in a second. There's great advantages to the FHA loan. Even though there's fees, great advantages to it. So, remember I said that if you get denied, it's because you don't meet Fannie Mae's guidelines? Right. And then I told you alternatives. The primary sources for conventional loans are banks, Bank of America, Wells Fargo, and so on, and also savings and loans associations. Other conventional lenders that don't care about secondary market, for instance, credit unions, life insurance companies, pension funds, they could do conventional loans to you. Okay. mortgage bankers, and even private individuals. The various types of lenders specialize in mortgage lending for specific purposes and type of borrowers, such as commercial, construction, single-family, residential loans. As far as FHA, the key is insured, right? And they insure the lender, not you. So FHA, the key is that they're insured. They insure the lender, not you. Okay. And also, FHA, like I said, they do not lend money. Who lends the money? Let me know in the chat, please. If the FHA does not lend money to you, then who lends the money to you? Perfect, Leonard. The bank. Because what FHA does is insure the loan to the bank. Okay? So they don't lend money, they insure the loan. Okay? So you guys know in conventional loans, you got to put 20% down payment, right? We talked about this yesterday. In FHA loans, they usually don't require such a high down payment. Okay? So that's why they come with insurance already. Conventional loans, they ask for 20%, but they give you the option of starting with 5%, for instance. Give you that option. You want to start with 5%? No problem. But you need to insure the other 15. Make it 20. So they're insuring that with PMI. They ask for a third-party company to insure the loan, private mortgage insurance. With FHA, they give you MIP on this insurance. So it's a mortgage insurance premium. Right here, MIP. Mortgage insurance premium. This is different from PMI. It's the same concept, but PMI is private mortgage insurance. It's not the government insurance. MIP is a premium you're paying for the government insurance. Okay? Now, one of the biggest advantages, guys, and I know I'm going back and forth. Selene says it's the alphabets for me. Okay, so A, B, C, D, E, F, not that alphabet? The acronyms bother you. Okay. Look. Quizlets. At the end of each chapter, you've got to be doing the Quizlets. At the end of each chapter, you go to Quizlets that I created for you guys. Go there. There's the chapter names. I'm going to number the chapter so it's even easier. But all you got to do is search for the chapter that you just covered in Quizlet. Go through that. Okay? If you guys are not doing something that will, like, because Quizlet is flashcards. If you're not doing something that will refresh your memory like that will help you remind keywords, this exam will be difficult. Okay? Not everybody has the ability of just listening and passing, or just reading and passing. Some people need the flashcards. No, do not. Okay, so hold on. Let me show you real quick. Oh. On. There you go. All right. So Quizlet is like flashcards. So it's not a test. So don't do tests. There's options there for testing, but I did not prepare this for testing. You have the review tests at the end of each chapter. So I'm going to show you right here, first of all. We're in chapter 17. All right. You have the class replays, part 1, 2, 3, and 4. Then you have quizzes right here, review quizzes. Okay? Do this as a test. Do this as a test. Quizlet is different. Quizlet is flashcards. So you're going to go here to the nationwide portion or national portion that we're going over. And you're going to either type here to filter, or you're going to scroll down until you see real estate finance. And we talked about acceleration clause yesterday. What is the acceleration clause? So it's a flashcard. Okay, it's not a test. There are options here for you to test. Do not do these because I did not create this for testing. Okay? Do the flashcards only. You can do the match if you want. Flashcards or match only. Do not do the other ones. I did not create this for testing. Okay? For testing, you have review quizzes at the end of each chapter. And once you've completed 90% of the course, or by next week, then you go here. Under school resources, under the course resources, you have this here. Then you can test yourself. Okay? Like overall. For now, you should focus, and you guys should have been doing this already. You should focus on doing, like I said, the review quizzes, okay, and the flashcards. There's 61 in this chapter. 61 flashcards. Okay? We talked about all these. All right? Discount points, foreclosure, interest, right? Click on it. It tells you what it is. Okay? So you're having difficulty with picking up certain things? Go here. Do this. I created this for you guys. Free resources for you. It's included with what you pay. Right? I can guarantee you there's not many schools offering this. So take advantage of what you have. Take advantage. Jump at it. Very important. They're all free. I pay for the service to be able to be here for you guys. Take advantage. All right. Tiana, you said you do the review test. That's great. You got to do a combination of both. Right? So at the end of each chapter, go test yourself. Great. But ongoing, do the flashcards. It keeps everything fresh. I'm telling you. It's 4 weeks. It's a lot of info. Right? I know it's a lot of info. And that's why you need these. For a lot of you, you need this support. Right? Some of you, just listening to it over and over is going to work. Some of you, the flashcards are going to work. Some of you, testing is going to work. People ask me sometimes, Bruno, what's the best way to learn? Whatever you feel comfortable with. I cannot tell you the best way to learn, right? I went through school back in Portugal. I went through school not paying attention to the teacher. So it's different. Everybody's different. Now I cannot do that. I have to pay attention to whatever is going on. Like back in the day, it was easy, okay? So make sure. Oh, well, that was back in the day, okay? Not anymore. Brain is fried. So make sure you find your way, whatever's working for you, all right? For some of you, like YouTubers, they're listening and coming into my classes, and for some of them have been helping. I've been getting emails or messages back and forth saying that they passed the exam and wanted to thank me, whatever. That's great. That means that this is what you needed to help pass, right? So find your way. Find your way. As soon as you find like, oh, the flashcards help me, great. Don't do just the flashcards, but focus on the flashcards because it will help you. I had a dinner yesterday with 3 people. There were 3 students. It was the mother, the daughter, and the son-in-law. All of them passed, right? So we went to celebrate, and one of the things that the daughter was saying is, Bruno, as soon as you told me to switch, I was so focused on Quizlet and I was not getting it. As soon as you told me to test, that's when I passed. So that test that I told you, once you complete 90%, that's when she passed, right? But I'm not saying that it's going to be the same for you. I just saw the struggle, and she was so focused on one resource only, right, that she was missing out on the best resource, which is testing, 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 right? So take advantage of everything you have and find what's best for you. Use everything else as a support, as an add-on, all right? And I'm telling you this from the bottom of my heart. If you want to pass, you got to do that combo. Find the one thing that helps you, right? And then combine with everything else. But find that one thing that helps you, that works for you, right? For some people, just listening over and over and over again, you get it. How do you put up with my with my bad jokes over and over? I don't know, right? But if you want to listen to me over and over, the class replay is there. That's it. All right. Anna wrote, you're right, many schools don't do that. That's very nice. Yep. And if Anna, if only you know what I have in store for 2021. If you think this is already good, wait for greatness. I'm gonna have those Quizlets with videos. Yeah. So every little thing is gonna have an explanation with it coming up. Yep. All right. Are the Quizlets set by chapters? Yes, sirree, they are. Go back here. Let me show you. Each one of these is a chapter in your book. So we are talking about real estate finance right here. Right? We talked on chapter 15, real estate economics. We have appraisals. We have real estate investments coming up on Monday. Overview of licensing regulation, risk management, chapter 24, and so on. So everything's in chapters. What I'm going to do, so you guys don't have to search much, I'm going to put the number of the chapter in front of it, okay? I don't know what else to do for you. All right, moving forward. Yep, forever and ever and ever. It takes a long time. And between teaching and having the time to prepare that, yes, it's tough. And then I have people texting me at 2 o'clock in the morning, Bruno, what's the answer for this? What's the answer for that? And here I am at the office replying to those. Yep. Anyway. Tiana, how many times can we take the test? Which one? My test? The one that's on the website? So, once. No. I start charging after the 100th test. I start charging. So up to 100 tests, you can do it for free. 101, I start charging. About 50 cents a test. Juan, no, I cannot take the test for you. Even though we got the beard, right? And your wife is my boo. Sorry, can't. Can't do it for you. All right. Good morning, Mealy. Hey, Ruth, what's up? All right, cool, guys. Sorry, can we still join the class like you're here? Have you not been here, Tiana? Like, can we still join the class? I'm like, you're here. Future classes, you guys have to up to 1 year to join any class you want. I don't want you to. I want you to pass right after you're done with this. But have up to 1 year. That's what you paid for. Should increase the value, like $300 something or whatever it is. Whatever you guys paid. For 1 year of me. I charge more. All right, back to this. FHA. The most common FHA loan is called FHA 203B, but nobody calls it 203B. They just say FHA, first-time home buyers. That's what people say. B for buyer. Okay, first-time home buyers. And the first-time home buyers applies to 1 to 4 family. So, with an FHA loan, a government-sponsored loan, government-insured loan, you can buy a 1 to 4 family residential property. Hey, Valerie, what's up? Good morning. So, 1 to 4 family. We have a great crowd showing up here in the morning from YouTube. Cool. Now, one of the things I don't like about FHA is the appraisal requirements. The only, I mean, every bank has this appraisal requirement, but FHA is very explicit when it comes to this. They say clearly, if your house does not appraise, we are not lending, period, right? But they leave an option, to the borrower to come up either with a difference, right? To come up either with a difference or walk away. So that's why when there's an FHA loan, like if you guys have a borrower, just let you know, you guys have a borrower that's FHA, right? And they put an offer. You have to include also an FHA addendum, right? So it's an additional piece of paper that tells the seller, hey, seller, this mortgage is subject to, this purchase is subject to an FHA loan. If your house does not appraise, then FHA will not commit, and the buyer has the option of either coming up with more money or walking away. All right? So that's the thing about FHA. Depending on the type of property, I already tell my clients, let's move to another one, not this one. Depending on the type of property, I'll tell them right away because FHA requirements, overpriced. I can tell you right now, this property is overpriced. It will not appraise. We can give it a try. We can spin our wheels and waste 2 to 3 months here, right? No problem. But I'm letting you know, it will only be approved by some type of miracle. And it has happened. It has happened where by $5,000, they were able to push and get it approved, right? I'd never thought that particular house would actually get approved at all, but the appraiser apparently was very friendly for that transaction, okay? I don't know. They decided to move the value up. It worked in my benefit because my buyer did buy, right? And it was the house they wanted from the beginning, okay? It wasn't even the house. I did not search for them. They asked me, hey, Bruno, right next to my brother, there's a house. I'm like, you want to live next to your brother? I'm running away from family. You want to go next to your brother? Yeah, right next. We actually have a shared driveway. Like, oh, okay. That's a house you want. But then it was under contract. And luckily, the contract fell through. And here comes Bruno after showing 10 houses. Here comes Bruno, contact the people. Oh, your contract fell through? Great. Your neighbor has a brother that's my client and wants to buy. Let's do this. And it worked. All right? But the appraisal requirements, that's what makes people lose the deals a lot of times. Okay? So that's why we must be good at evaluating properties. We must be good at figuring out, oh, it's listed for 400, but is it worth 400? So you don't put offers because it's at a particular value. Right? So what they do is they give you a maximum loan amount, right? Maximum loan amount. And then they have an LTV. What is LTV, guys? Who knows what LTV is? Tina, yes, they only give the appraisal amount. But if it doesn't meet the value, right? Doesn't meet the value, then you can come up with a difference. You just put more money. So in that question, right? Danny, LTV, loan to value, perfect. So let's say the value was or the appraised value was $100,000. The LTV or loan to value was 80%. So 80% LTV. That means $80,000. Right? That means your down payment is the difference. Right? So that's $20,000. That's the value. But the purchase price, what you agreed to, was $102,000. How much money, because this could be an actual question in the exam, how much money do you need to close? See, the bank is only going to give you money based on $100,000. They're not giving you money based on $102,000. They're giving you based on $100,000. So you have to come up with a 20% down payment, which is $20,000. And then you have to come up with a difference between purchase price and value. So that's $2,000. Okay? So this difference plus the down payment is the total cash to purchase, so 22,000. If you don't have the extra 2,000, what can you do? FHA guidelines said from the get-go, if you don't have the money, you can walk away. No harm, no foul. So that means that the seller cannot come after you for backing out of this deal. And that's what we call contingencies. Remember? Contingencies. So subject to, contingencies, conditions of this offer, right? So one of the contingencies, well, it's subject to FHA, subject to VA, subject to appraisal, subject to whatever. Tina, yes, the seller could say, yeah, okay, fine, we'll give you a credit of $2,000. Yeah, they could lower if they want to. Yeah, they could. Good luck with that. Good luck having a seller that says, oh, you want me to drop the price? Sure, right now. I'm so excited about dropping $2,000 out of the value of the house. All right? No one said ever, right? But yes, it could happen. I'm not saying it's impossible, but usually the seller wants the maximum amount of money. So if they want to sell, they want the maximum amount of money, while you want the lowest possible. Okay? So again, this could be a question in the exam where the value is 100,000, but you're purchasing for 102. The LTV is 80%. How much must you bring to closing? You must bring the down payment plus the difference of $2,000 or walk away. All right? Now, down payment requirements. For FHA, the current down payment requirement is 3.5%. %3.5%. You guys remember what FHA is good for in terms of what type of properties can you buy? Does anybody remember what can you buy with an FHA insured loan? What type of deals can you get into? Can you buy a commercial building? No. So what can you buy? So Nady, perfect. 1 to 4 family, correct. All right. So 1 to 4 family at 3.5%. Okay? Do me a favor. You want to help people? If you really want to help people, if you're not in this business for the money, because money will come. If you really want to help people, take advantage of the lowest down payment possible. Get them into a multifamily that will pay their loans, so then eventually they can get that single family. 9 out of 10 times, I explain to them, very simple. If you lose your job, who's going to pay for the mortgage? Okay? If it's a single family, it's guaranteed that the answer is nobody. Or my husband cannot afford, or my wife cannot afford, or my significant other cannot afford to pay by themselves. So, get them into a multifamily. If not a 4 family, get them into a 3. If not a 3, get them into a 2. At least it's some type of income. And then they have to stay here for a year. Under certain conditions, you might be able to move sooner, but at least a year before you go into another property. But now you have an income property that's helping you. All right? 1 to 4 family with a 3.5% down payment. Choose 4 families all day long. Right? And anybody that tells you guys, and you guys are going to go through this, I'm an investor first. I've been doing this for almost 16 years now. Right? I'm an investor first. I don't look at areas. I look at income. A lot of people are like, hey, I want a 4 family. Right? Somebody walked into my office, a student from the evening class, comes here, shows up in my office, and goes like, hey, what's up, Bruno? I was in the area, just wanted to say hi. And this, okay, great. What's going on? Right? I gave him the tour, so on and so forth. I actually had a client here at the time, but I still gave him a quick tour of the office. And he said, hey, I need your help. I'm like, okay. I want to buy a 4 family. I'm like, okay. Where do you want to buy it? He gave me the area. I'm like, you know there's not many 4 families there, right? Possibly none. Like, yeah, but that's the area. Okay. Are you looking to invest? or you just want a four-family. There's a big difference. I'm looking to invest, right? So I always want to get the cheapest house in the best neighborhood. That'll be great. But I also want the highest return on the property. So I just helped a student not too long ago. I helped a student buy a four-family. Actually, they were about to close this week. Buy a four-family for less than 500,000. Four-family for less than 500,000. The rentals are 1,300 and up. Okay, so 2 rentals almost pay for a mortgage, and then 1 rental comes into your pocket, and then you have to live there for a year at least. But once you move out, it's 2 rentals coming into your pocket, so 2,600 coming into your pocket. There's people that don't make 2,600 a month, and she's going to make 2,600 a month. You guys understand? In 1 year. Boom. Now, if you ask me where the property is located, it's not in the most desirable area. No. But 2,600 a month. Clean. That's all you got to remember. Forget the area. Look at the income. Oh, people are going to destroy the apartments. Doesn't matter where you are. I've had that experience. Doesn't matter where you are. Had properties all over. Doesn't matter where you are. There's always somebody. Okay? There's always somebody that will destroy your home. There's always a tenant that has the option of destroying your home. I had a property, a 2-family in the nicest neighborhood, and the tenant on the second floor destroyed the home. Okay? So they're going to do it no matter what. So then he says, do it now. Kids are home, so they don't have to worry about the schools. Yeah, take advantage. All right. Valerie says, I want a 4-family, my dream. More than 1 4-family. Used to want it in the Ironbound. All right, I have to laugh a little bit. I used to want it in the Ironbound too, but have you checked the prices lately? Okay. Crazy. Crazy. Real estate is crazy here in the Ironbound. Anyway, moving forward. Low down payment, high income properties. Okay? Think about it that way. One of the things that's really good about, and we're going to end the FHA, we'll take a break and then we'll come back for the other ones. Yeah, Valerie, prices are ridiculous, so not worth getting a 4-family right now, here in the Ironbound at least. Wait a little bit longer. Prepayment privilege. So in most states, the lenders can charge a prepayment penalty. What is prepayment? You paying earlier than what was due. So you had a 30-year loan, but you paid in 15 years, right? Or you had a 30-year loan, but you paid in 2 years. Or you won the Mega Millions, and instead of 30 years, you paid in 2 weeks, right? So most states can say, most states allow the lenders to charge you a percentage or a penalty for paying too soon. If it's an FHA loan, FHA or VA, they tell you, nope. If we're a government-insured program or a government-sponsored guaranteed program, you cannot charge anything. So there's no prepayment penalty for FHA loans. No prepayment penalty for FHA loans. Danny's asking, so where's a good place for a 4-family? Look at the rental incomes in the area. Most of my properties are in South Newark. Taxes. The reason why I don't go to Irvington, for instance, is taxes are high. South Newark taxes are low. So look at the income, right? Look at the income that it brings, and look at the price. So it's not where it's a good place to buy a 4-family. It's look at what you're purchasing for and what the rentals are bringing, or potential rentals. Okay. And when you look at what you're purchasing for, also look at the carryover costs, which is the taxes, for instance, insurance. Right? You have to understand those. Okay. Anna says they just went up again. What went up? Oh, in Irvington? Because you're in Irvington, right? I don't buy in Irvington. I don't buy in Hillside and Elizabeth. I'm running away from because taxes just keep on going up. But again, South Newark, like half of the taxes of here in the Ironbound. That's why I sold the last property in the Ironbound. I sold it about 4 years ago. My taxes were almost $14,000. So I had one rent. One rent was pretty much for taxes, insurance, and a few other things. And it was a two-family, so it just didn't make sense. All right, so that's it. Interest rates. Interest rates have nothing to do with FHA or VA. Interest rates is between the lender and the borrower. So when you talk about FHA loans, the only thing that's secured there that you'll know is the 3.5% down payment and the 1 to 4 family option. Okay, everything else is lender. Okay, they can limit though. FHA can limit the amount of points and fees and costs that they will charge you, right? Or regulate the amount of points fees that they're going to charge you, but they don't regulate the insurance. Okay. All right. So, in addition to the FHA 203B, which is the buyers program, the first-time home buyers, there's others. There's for instance, the 203K for home improvements, right? There's 4 family loans for subsidized loans for low middle income families. There's loans for condos. There's loans for multifamily projects, graduated payments, and adjustable rate loans. So FHA simply means insured by the government, and there's all these options, just like a conventional loan. There's all these options here, just sponsored by the government. Okay. All right, we're going to cover this after the break. Sinead is asking, what's a 4 family going for in the Ironbound right now? You really want to know? I'm going to put it like this. There's a 3 family right now for 1.5. Yeah. Yet, you can buy the same 3 family. The same 3 family. You can buy in South Newark for 400 or less. Okay? I don't know why people stay away from South Newark and North Newark. Everybody just wants the Ironbound. Money talks. Anyway. All right, guys. We're going to go into a... you can charge... Not enough. Sorry, today. Not enough to cover the 1.4 million. You can change the rate. You can charge more, whatever you want. Not enough to cover 1.4 million. It's 12 o'clock, guys. 12:02. We're going to be back 12:15. So I will end the YouTube session, guys. I'll open another one right after. So 12:15, we will be right back. Thank you, guys.